Right, I make that 10:30 by my clock. So good morning, everyone, and welcome to this morning's AVC Wise hosted webinar entitled The End of the Tax Year Approaching, Act Now. My name's Jonathan Kempson. I joined AVC Wise in 2018, but prior to that, I was 20 years with the Prudential. And for a lot of you on this webinar this morning, well, 2/3 of LGPS use the Prudential as the provider of local government AVCs. I know there will be a lot of you also on who've got Standard Life or even some other AVC providers as well. But I've got many years experience dealing with LGPS. And what I wanted to do, particularly as we're on the home straight for this tax year, is run this particular webinar just to highlight some of the things you should be aware of before you run out of time at the end of this tax year. Right, before we go any further, some important information. Obviously, everything I'm going to be telling you today in today's webinar is factual information only. It does not constitute financial advice. And of course, when it comes to tax, our information is based upon current taxation, legislation, and HM revenue customs practice. Of course, these things could change in the future without notice. And ultimately, of course, the impact of taxation and any tax saving will always depend upon your own individual situation. Now, if you're after specific tax advice as to what to do, then we suggest you consult a financial advisor for individual advice. Okay, so what are we going to be covering this morning? Well, we're going to talk about the latest version of AVCs. Of course, all your respective employers have launched via AVC Wise the ability to pay AVCs through salary sacrifice, or what we just abbreviate as Shared Cost AVCs, by far the most efficient vehicle for saving an additional pot of money whilst you're an active LGPS member. But as I was saying at the beginning, it's about understanding where we are at the moment. Can't believe we're almost in mid-January already, but we are rapidly running out of time for the end of this tax year, which ends on the 5th of April 2022. And it's the kind of things you as an LGPS member should perhaps be considering before we're done on this particular tax year. So we'll just firstly do a recap on shared cost AVCs, refresh your memory as to what they are and the benefits of being a member of the scheme. We're going to look at some key facts about the tax year, and then what we're going to do, and don't worry, we're not going to do it in too much depth, but just a sort of very light touch in terms of how income tax is calculated and get you thinking about your own personal situation, and ultimately get you thinking, well, how tax efficient are you being at the moment if you're not already participating in shared cost AVCs. We'll explain the tax saving opportunity that you have if you put some of your hard-earned money into these things, and then we'll try and bring it to life with a couple of case studies whereby we've got two hypothetical members, different levels of salary, one's basic rate, one's higher rate, and what the numbers actually mean for them if they supercharge their pension contributions before the end of the tax year. And then ultimately, how do you make it happen if you're new to these things? How would you apply? Or indeed, if you're already doing them, it's a question of reviewing or amending what you're paying. How would you go about that? So we'll cover that off at the end as well. So by way of a refresher then, all a shared cost AVC is an extra pot of money which you're building up with whoever the chosen AVC provider is. And that's, remember, that decision is made by your respective LGPS pension fund. So, you know, it might be Prudential, it might be Prudential and Standard Life, it might just be Standard Life, it could be Legal and General, could even be Clerical Medical for some of our Welsh clients. But the bottom line is this: how you actually pay into these things, you can only pay into these things via your monthly salary, your LGPS salary, of course. And that's why it's so important to recognize, well, look, if I haven't been paying into these things all tax year, I can only pay on a month-by-month basis. I can't backdate for all the months I've missed from last April at the beginning of the tax year. You can't get the checkbook out and write a check to Pru or Standard Life or whoever the provider is to play catch-up. All you can do is potentially maximize your contributions out of the remaining pay slips of this tax year. So, you know, we're basically too late for January, I'm afraid, but you have got February and March left before we're done this tax year to make some valuable savings. So the name of the game is to try and build up as big a pot in your own individual situation as is reasonably feasible. And then you'll have loads of flexibility about what you do with that extra pot of money, whether you take it as tax-free cash or whether you use it to buy income. But on the way in, remember, you're in absolute control as to how much money you pay into this thing. The minimum contribution is £2 a month for some of you, and it does vary case by case. But if you're looking to maximize your tax saving opportunity, in some cases you can go circa 60% of your gross monthly pay. You can't get rid of all of it, but you can do a very large chunk of what you actually earn into these things. And members do that as you get towards the end of the tax year because of those reasons that you can't backdate or write a check. As I said, remember that money always sits with whoever the provider is, whether it is Pru, Standard Life, and the various names you see on there. So you don't get to choose who the provider is. That's your respective LGPS pension fund. But what you do have absolute control is within whichever provider it is, there are a range of different investment levels of risk you can take with your money. And the good news is there's something for everyone. Even if you're completely risk averse, you could put this into a cash fund. If you want to put it in some of the stock market, or even get a blend, £100 here, £100 there, you can do that, and you can change everything anytime anyway. So I know investments can be for the uninitiated, a bit of a block in terms of the application, but actually there's genuinely not a huge amount to worry about. There are even potentially default funds, not for everyone, but for a lot of you will have a default fund, an automatic fund. Not to proceed because you weren't sure which investments were right for you. I'm afraid, to do nothing is probably the worst thing as you run out of time at the end of the tax year, because huge savings to be made legitimately by HMRC on this, irrespective of which fund or funds you go into. And lots of flexibility at how you take it out. Most of you will take it all as a tax-free lump sum within limits, or you can use it to buy income. Don't worry about that now. You make the decision that day when you actually retire. Okay, so unique opportunity. Why shared cost AVCs as opposed to, and it's interesting, the last couple of days we've had a number of your colleagues in LGPS who said, well, actually, I'm paying something into a private pension. So that's what I normally do. I pay a direct debit and put some extra money in that way in my own private pot. Well, you might want to rethink that if that's you, because if you go for shared cost AVCs, here's the unique trump card you can play when you do a shared cost AVC. This extra pot which you're building up, did you know that if you cash that out at the same time, so the same time as your main local government pension scheme, whenever that is, a calculation is done, and in the vast majority of cases, members, if they so elect, can have it all back as a tax-free lump sum. Who'd have thought that? Pay into a pension pot, get loads of relief on it, get it all back as cash. Now, there is a limit. Overall, sounds almost too good to be true, doesn't it? But remember, the maximum tax-free cash you can take back from LGPS is 25% of the capital value of your local government pension scheme. Okay. What they do very briefly is they take your pension at retirement, and they've got to work out how big it is towards something called the lifetime allowance. This is a tax allowance, £1,073,100. Well, how do you do that if you've got a pension of X amount per year? Well, you multiply it by a factor of 20. They're not assuming you're going to live 20 years in your retirement, but a pension of 10 grand a year, for example, is worth 200 grand towards the lifetime allowance. So very quickly, that's quite a big pot in inverted commas. Plus, you add in any automatic lump sum. If you've got service before April 2008, remember you've got an automatic lump sum. Plus, you add in whatever you've been savvy enough to save into a shared cost AVC pot as well. So you add all three together, and it's 25% of that. What that means basically for you is the vast majority of you will have no problem in taking it all back as tax-free cash. And I tell you what, this is where the smart money is now going, because with these things, with shared cost AVCs, you're going to get a double tax break on it as well. And then you can get it all back tax-free. All kudos to you at your point of retirement. As I said, lots of flexibility about what you pay into it, and members really like that. So you can adjust depending upon your cash flow. Could be as little as £2 a month. Could be I'm chucking the kitchen sink at the end of the tax year. Might be able to go 60 odd percent, or in some cases, possibly even a fraction more. If you're looking to do large contributions at the end of the tax year, we put in place some support, some additional support for individual meetings for those members. We'll touch on that a bit later. But why do you do it in the first place? Why bother? I'll tell you why. Number one, tax relief. Whatever rate of income tax you pay on your LGPS salary, you're going to get that relief at source. Brilliant. Gets better. Of course, because it's a shared cost AVC. So remember, your employer took a proactive decision to introduce shared cost AVCs. They're genuinely doing you a huge favor, because if you pay national insurance, when you pay into a shared cost AVC, you're going to get a national insurance break as well. Unlike those members who've said, well, I'm going to just do a private pension, there's no national insurance break on that, because remember, these things are paid through your salary via salary sacrifice, so you get double tax breaks on this. Yeah, potentially they're all back tax free. What do the numbers actually mean? Well, if you're a basic rate taxpayer, what that means is you get £100 in the pot, and it's only going to cost you £68.12 to do it. Okay, so that's all your light at the end of the month out of your pay packet, but £100 has been credited to your shared cost AVC pot with whoever the provider is. The green arrow tells you why. That's a really good thing to do. 46.8% return on your money before the thing's even invested. You start to see why people will pay, in some cases, large sums in, because where else are you going to get that type of return at the moment, given where interest rates? Now, of course, the downside to this is, remember, that money is locked away until currently as early as age 55. So you're not going to put money into this which you're going to need access to before that age. But certainly members who say end of tax year or getting close to retirement, if you can get that yield on the green arrow there, you're literally laughing all the way to the bank, aren't you? That's if you're a basic rate taxpayer. If you're a high rate taxpayer, and we'll define higher rate tax shortly, well, look what's on a plate for you there. £100 will only cost you as little as £58.02. How long would you have to invest £58 to turn it into £100? Yep, north of 72% return on your money. No surprise that 40% taxpayers will look to pay extra sums into pensions in an ideal world, depending upon the numbers, of course, to actually make themselves a basic rate taxpayer. It's what we call top slicing in the industry. And if you're in this tax bracket, it's a key part of your own personal tax planning to understand what your liability is, and then what is reasonable to mitigate that 40% liability. And of course, there's been lots of rumours that they're going to get rid of 40% tax relief on pensions. Who knows? We simply don't know what the future is. But there is also that phrase, make hay while the sun shines. And that certainly is good haymaking at north of 72% return on your money. And of course, when you invest that money, then with the provider, you get control as to where it sits. So remember, those investments could go up, they could go down. Look how poorly those providers would have to deal with your money for you to be personally out of pocket. You're talking about 72% drop on your initial investment before you're personally out of pocket. So when members say, well, I'm really concerned about investments and all the rest of it, absolutely, you should be, but don't beat yourself up too much about, well, I can't make a decision, so I'm not going to do it, because you're going to miss out on the green arrow. Okay, so let's look at some key facts around the tax year. So we are currently in the 2021-2022 tax year. So that started way back in the 6th of April last year, and it's going to end on the 5th of April this year. Have a look at your personal allowance. So on your pay slips, you should be able to see what your tax coding is. And this is the amount which you can earn without paying any income tax. So, you'll show on your payslip 1257L is the standard coding, but guess what? You might not have a standard personal allowance. It might be slightly higher. It could be less than that. Yeah. So do have a look at that coding because that's effectively what you can earn before you even start paying any income tax. It's your 0% tranche. And as I said earlier, it's about understanding where you sit in terms of income tax and then managing that liability. And if you can do additional pension contributions, AVC, shared cost AVCs, to reduce down that total gross salary, that's a great thing to do in terms of tax efficiency. But always remember, effectively, you've only got February and March left to actually do that. Now, something else, just to make you aware of, if you weren't, I'm going to mention two words. First word is fiscal, second word is drag. Those of you who read the financial press might be aware of the fact that the standard person allowance has now been frozen for the next few tax years. Okay. Now, you might think, well, that has little or no effect. So what? They do have a history, though, the person allowance are going up a little bit each year. But the Chancellor has decided to freeze this for a number of years. So what does that actually mean? Well, I'll tell you what it means for you is that if you get any type of pay award, whether that's just cost of living or whether it's something more substantive than that, you get a promotion, you take on more responsibilities, the bottom line is you are going to pay more income tax because your personal allowance is frozen. And if you look at the next few years, the tax take from this is probably going to be about another 20 billion is going to go into the government coffers. Now, of course, a lot of that money is very much needed. But of course, on top of this, don't forget what's also coming over the horizon is a national insurance increase with effect from April. So how do I sort of shelter my hard-earned money from what are going to be inevitable economic headwinds which we're facing? Well, the answer is actually really simple. You put more money into things like shared cost AVCs because you'll get tax relief if you're a taxpayer, and if you pay national insurance, you're going to get NI relief as well. So let's have a quick overview of income tax to see how it all works then. Remember, your salary in LGPS, you're on PAYE, pay as you earn. Now, some of you may have additional income from other sources. If you've got rental income or other untaxed income, then you may well be familiar with self-assessment. But if you don't have any of that, then you just have PAYE, so it's relatively easy. So you take whatever your personal allowance is. By the way, if you're a very high earner, you might not even have a personal allowance. So if you're earning well over 100,000, you start to lose it in terms of your personal allowance on a 2-for-1 basis for income over 100 grand. So you get past 125 odd grand, you get no personal allowance. Most of us aren't in that situation, though, of course. So have a look at your standard personal allowance, whatever that is, that's your 0% tranche. Then, assuming standard personal allowance, if you're between 12,571 and all the way up to 50,270, so that next tranche of 37,699, that's what we call a basic rate taxpayer. Okay, so if you sit in that band, you're a basic rate taxpayer. If you earn a little bit more than that, anywhere from the 50 odd grand up to the 150, that's your 40% tranche. Okay, but remember, you only pay 40% on the bit which falls into that tranche, and then you'll have a basic rate tranche as well. So it's known as what we call a slice system. You pay so much at each different tier depending upon where you are on the salary scale, and for very high earners there's an additional rate of income tax. So what you should be doing for your own sort of self-governance, if nothing else, is understanding, well, where is my gross salary on that slice, and then thinking, well, okay, if I go into the next slice up for whatever reason, what is my exposure at that level? What can I do to mitigate that? And for example, if I'm a higher rate taxpayer, to what extent am I in the higher rate band? Can I do some additional planning to actually drop my salary down to the basic rate banding? These are key fundamentals which we should all be looking at in our own personal situation. So don't forget that even if you are in, for example, the 40% band, actually the first thing to start saving tax relief immediately is your core contribution to LGPS. So whatever band you're in, basic rate, higher rate band, whatever your core contribution is, and remember that's a percentage of your gross pay, and depends, where you are on the salary banding as to what that percentage of your salary is. But that is the first thing to go off the top line. So it could well be that, if you're in your low 50s as a gross salary, well, actually, after you've taken off your core contribution to LGPS, actually, you're then a basic rate taxpayer. Now, as we've seen, there's still plenty of advantage to putting additional sums into shared cost AVCs, because your £100 then is only going to cost you 68. So it's still brilliant. But it's more, you would perhaps argue it's even more pressing that if you have stuff left over still in the 40%, well, what is that? Because then I can pay whatever that sum is in to get myself as a basic rate taxpayer. And that's where shared cost AVCs are brilliant. Use it as a tax management tool to grow your wealth for your retirement. It's simply going to give you more options to retire early and/or with more money. Let's try and bring it to life with a couple of examples. So we've got Joe. Now, Joe is a basic rate taxpayer, 30,000 a year. Now, we're going to assume Joe started his payments into the shared cost AVC at the beginning of this tax year, so back in April 21, and he did as much as £250 a month. Now, remember, the gross contribution he put on his AVC-wise application, £250 as a basic rate taxpayer, has personally cost him out of his net pay £170 odd a month. So he's already getting almost £80 in tax saving, which is great. So he sets off on that path. But then as the tax year progresses, he decides he wants to sort of supercharge his pension contributions. And before the book shuts on the tax year, he wants to, what we call, literally supercharge it and get some more money in the pot. Now, you might think, well, how on earth could someone on that salary afford to do £1,000 a month gross? That's pretty chunky stuff. Well, have you thought about this angle? It could be that Joe has actually come into some money somewhere else. He's got some investments. I don't know. He's got a deposit account. He might have had some premium bonds or whatever. He's got some savings he's built up. Now, the point is, if Joe doesn't need access to those savings until he retires, and that's an important caveat, if he doesn't need access until he retires, Joe is thinking about the yield on his money. Now, any of you who are invested in deposits and cash-like funds at the moment, of course, that's great because you can, generally speak, get instant access to those things. It's very important that all of us have what we call an emergency fund, and what you define as emergency fund is very personal to you. A general benchmark would be 3 times net monthly income. Anything over and above that, you've got to be looking very hard as to how hard your money's working. And if you're sitting in deposits and cash at the moment, well, guess what? There's something called inflation at the moment, and it's looking as if that could be quite sticky. They're hoping it's going to be a temporary thing, but obviously energy prices are really setting inflation on fire at the moment. So if you're running at a headline rate of about 5%, well, are you getting 5% interest on your cash at the moment? Well, the answer is no, isn't it? You're getting a derisory amount, even though Bank of England base rate put up a token amount. The point is, you're getting negative compounded returns on your wealth. Over a prolonged period of time, that is the silent killer on your money. So what Joe's then thinking is, well, look, if I don't really need that money snoozing away there, what I'm prepared to do is supercharge my shared cost AVC before the end of the tax year. So I can't directly pay that money in because I can't do a check, but I can take a bigger chunk out of my LGPS salary. So if I do £1,000 a month, I know in my February pay, it'll cost me £680. In my March pay, it'll cost me £680. Okay. Now, that's a huge tax saving just over, each month is a huge tax saving. Over those last 2 months at the end of the tax year, he's decided to save himself just under £640 in tax and NI. Just like that. Yeah. So there's his yield of over 46 odd % on his money before it's even invested. Now, of course, we don't know what those investments are going to do with Pru and Standard Life. They could go up, they could go down, But the point, even if he stuck it into a cash account with the provider, yeah, he'd have saved himself just under £640 in those last 2 months of the tax year. And that's if you're a basic rate taxpayer. You start to see where people who can afford to do this will do. And if, of course, Joe's done his numbers, potentially he could then take the whole lot back as tax-free cash when he retires. Brilliant. That's called tax efficiency. Let's run the scenario with Jane. Now, we're going to assume Jane is a higher rate taxpayer. In fact, we'll give her a salary of 60k. In fact, that's after we've knocked off her core contribution to LGPS. So, yeah, real salary is what, north of 65,000 total gross. Knock it off 60,000 after that core contribution. Let's imagine Jane's been doing exactly the same thing as Joe. She'd been regularly saving in £250 gross a month. Now, because she's a 40% taxpayer, her £250 in the pot each month has actually only been costing her £145 a month. Yeah, it's over £100 a month the taxman's been putting in for her. Great. But then, of course, she gets her light bulb moment, just like Joe. Well, hold on a minute. Even if I did that, I haven't even burnt off all of my 40% liability. Now, she might not be able to afford to burn it all off, even if she accelerates it and supercharges it as an extra £1,000 for both February and March. Yeah, in February and March, both of those months, it's only going to cost her £580. But £1,000 will go straight in to that provider each month. Brilliant. Yeah. Over 2 months, those last 2 months, Jane, you save yourself just under £840 instantly. Instantly. Now, of course, you might be on this webinar and you might not have even been paying any regular contributions up to that point. So, not uncommon that members in that situation say, well, how do I play catch up for those earlier months? Well, remember, you can't write the check. So you might, if you're in the position, be able to throttle up and do your maximum contribution for February and March out of your pay. And then when you get into April, well, you've then got 12 months, you can then throttle back down and average out that contribution over that period, can't you, to burn off whatever you want to burn off. That's the beauty of the shared cost ABC. You're in control as to what extent you go on the throttle or not. Now, I'm going to throw in another angle as well. And how about this? Any of you who are on this webinar who are a mum or a dad, so mums and dads who are 40% taxpayers. Okay, so if that's you, I want you to think really carefully about this. So we've got Charlotte here, high rate taxpayer, and Charlotte is a mum and she's got 2 kids, and either Charlotte's been claiming it or her partner's been claiming child benefit. Well, how much is that then? Well, for this tax year, if you've got 2 kids, it's effectively almost, so it's just under 1827 spot 80 of tax-free income. Great. But, and there's always a but, isn't there? Because Charlotte earns over 50,000 of what we call adjusted net income, that's after you've taken off your core LGPS contribution, that's what that means. She must pay the high income child benefit charge. Now, what you can't do with this stuff is you claim or your partner's claiming it and you're in this situation, you're earning over 50k of adjusted net income, and then just plead ignorance if the taxman comes knocking to say, well, hold on a minute, you've got to pay some of this money back. It's done on a taper. If you're between 50 and 60k, once you get past 60k of adjusted net income, you've got to give it all back. Okay, and it is a taper between the two. Now, we've spoken to members over the last couple of days who actually sort of panicked a bit around this and just basically, oh, cancel that. I'm not going to have any of the child benefit because it's too complicated. I just don't want it. Well, actually, you might be doing yourself a disservice there, because actually, if you plan your pension contributions right, you can get to keep all of your child benefit as well. One little point about this, though, is, if you remember on that slice deck I was showing you, the slices of where you go into 40% tax, if you got the standard personal allowance, actually 40% tax starts for you at £50,270. Actually, the high income child benefit charge starts at £50,000. They haven't moved that with the personal allowance over the years. So how about this? If you were earning 50,000 of adjusted net income, you are a basic rate taxpayer, but you might actually have to pay a little bit of your of the high income child benefit charge. So it could technically even apply to someone who is a basic rate taxpayer. Who'd have thought that? So what's the strategy then? If this is you, you're a mum or a dad, you're claiming the child benefit, or your partner is, and you earn over 50k of adjusted net income. Well, remember, by the way, if it's if you earn this and your partner is north of 50k as well, by you just getting below 50k doesn't save you from the high income child benefit charge. Your other half, if they were in that scenario, would also have to pay into their pensions to get below 50 as well. But if it's just you, this is you, well, here's a great strategy then, because what you could do is pay some money into your shared cost AVC, siphon off whatever that money is north of 50k. You're going to save yourself the income tax. You're going to save yourself the requisite national insurance. You're going to get below 50k, and then you get to keep all your child benefit back as well, effectively a tax-free income. That is incredibly efficient. So, when we looked at higher rate taxpayers getting a 72% yield on your money, well, actually, if you factored in then the fact you got all your child benefit back as well, your yield goes through the roof. Great bit of planning if that fits into your scenario. Some conditions and considerations. When you do these things, don't worry, it's not going to damage your main local government pensions. It always, for pension purposes, for your main scheme, is the pre-salary sacrifice or the notional salary. So don't worry about it. Can't get rid of everything each month. Got to leave enough in the tank to satisfy the national minimum living wage, roughly for some members, and it's a case-by-case basis. Need to stress that. Might go as sort of high as circa 60-odd%. A lot of you can't pay so much in throughout the tax year. You've gone below something called the lower earnings limit, £6,240. A lot of you, the system won't allow you to do that. We do have one or two partners where you could go technically below that. You really wouldn't want to. Why? Because if you reduce your salary down to that level, well, you could start to damage your state pension, which wouldn't be a good idea. And if you think about it, once you've paid so much in that you're a non-taxpayer, any further sums you're not going to get income tax relief on. 3 allowances you do need to be aware of. Firstly, annual allowance. How much can I pay into a pension and get it all out? Sorry, not get it all out. Pay in each year. It's £40,000 a tax year, which sounds a lot, but you use up quite a chunk by just being in your main local government pension scheme. So if there are any issues with the annual allowance, your pension fund is under an obligation to contact you. So if they've written to you with what's called a pension savings statement, they will outline what the issue is with the annual allowance. Even if for whatever reason you did go over the 40k, you can actually go back to the 3 previous tax years and carry forward any unused annual allowance there. Money purchase annual allowance. Word of warning for those of you over 55, pensions freedoms dictate that you can actually, if you've triggered this, you've cashed out an old personal pension, a pot of money. Well, that could be a little bit of a problem, because if you have triggered that, then you won't have your normal £40,000 annual allowance. It'll be as little as £4,000 a year. So it's going to really clip your wings in terms of what you can pay in to shared cost AVCs. The provider will let you know if you have triggered the money purchase annual allowance, but don't cash things in unless you know what you're doing, would be my steer there. And then the lifetime allowance, I touched on that earlier. All pensions from all sources, excluding state pension. If you go over the lifetime allowance, then you do get into punitive tax. So you've got to be sensitive to that. Remember, you're in control with shared cost AVCs. You dictate the amount you pay in each month. That can increase and decrease. And if you do move on, then you can't carry on paying into it, but the money's still invested with you with whatever provider, and hopefully still growing. So by way of summary, you've only got 2 pay slips left to save both income tax and national insurance. So if you're just waking up to this stuff, you do need to act now before the end of the tax year. If you're doing particularly high pension contributions and you're using the annual allowance, you're using even carry forward, well, it's on a rolling basis. So as you move into the next tax year, they look back to the previous 3 tax years. So if you've got plenty of unused allowance and you're looking to utilize that, now's the time to do it. Use it or lose it before we roll on to the next tax year. Remember, as I said, it's really easy to increase and decrease contributions anytime you do that through the AVC Wise portal. And if you earn over 50,000 after taking off your core LGPS contribution and you've been claiming child benefit, you've got opportunities to save on the high income child benefit charge. Maybe you've got other sources of income on top of LGPS. Well, another great way of saving that overall income tax liability is to pay additional sums in through shared cost AVCs, because when you put the other income on top of that, well, clearly it's going to be at a lower height, isn't it, if you've got rid of some of your LGPS salary as well. So indirectly, you'll be saving income tax on other sources of income. And it's all about efficiency for me with the unique angles that you've got with shared cost AVCs, tax and NI, ability to take it back as tax-free cash. This stuff is really the Rolls Royce when it comes to actually paying extra sums into a pension pot. Now, pensions are not straightforward, are they? So what we have done at AVC Wise is put in some additional support whereby if you are in a position to act now, I'm going to say that again. If you're in a position to act now, then there is an ability to have a one-to-one meeting with my colleagues at AVC Wise, and we can answer your questions, look at some individual calculations. Remember, we're not giving you financial or investment advice, we're just giving the factual information. But if that means that'll help you get over the line, then we're very much here to support you. Now, if you're in a position where you think, well, yeah, this looks quite good, but it's not for me this tax year, then please do not request a one-to-one at this stage. By all means, come back to us in the new year. We are literally seeing hundreds of people on our webinars at the end of tax year, so we have to put some strong caveats in around that meeting. Now, if you are ready to go and you just need some extra help, well, you need to do some homework for that meeting. When you book that in, we'll need an LGPS projection to your desired retirement age. That might be not your normal retirement age. So we'll be asking you, what is your forecasted pension and have you got any automatic lump sum? What are those numbers, please? If you're already on board with AVCs, an up-to-date valuation as well. Key will be up-to-date pay slip as well, because we need to understand your salary and whether you've got a normal personal allowance or not. And the other key thing you must think about in advance is, what is your affordability? You know, are you looking to chuck the kitchen sink at it, or what is that number you were thinking of paying in? Because then we can look at some calculators. We can calculate what your maximum shared cost AVC is as tax-free cash, and give you a target to aim at there. We can even consider, well, you know, to what extent you're into 40% tax, if that's something you're looking to mitigate, and that'll help shape our conversation. We'll look at some calculators for you as well. So if you want one of those because you're ready to go, I will tell you how to book one of those very shortly. In terms of those of you who are just very clear, well, I know what I'm doing, I just need to get on with it, I don't perhaps need that sort of in-depth consultation as such. Well, really easy. If you're new to shared cost AVCs, you've got to do your new application through the AVC Wise portal. So you log in as you to your own secure account, fill in your personal details, initially how much you want to pay into it. Remember, it can change. Select your initial investment fund or funds you want to invest in, submit that application. Your employer will then need to verify it, and then it'll be set up with whoever the provider is from the next available payroll. So realistically now we're looking at a February start, but don't leave it too long, because if you're not careful you might miss the payroll cut-off of February, and then you'll only have March left before the end of the tax year. So that's if you're brand new to shared cost AVCs. If you're already on board and it's just a question of amending as we run out this tax year, well, even easier, you just log on to your AVC Wise account and click the amend button. You simply then enter your new desired amount, and then same verification of the application needs to happen from your payroll team, and then given the fact that if that gets a green light, it will start from the next available payroll run as well. Last slide before I bring Greg in to answer all your questions. Around the one-to-one. So if you're ready to go, just need that helping hand. How do I organize one of those? Well, if you can drop an email to support@avcwise.co.uk, we'll let you know what the booking process is to set up that Microsoft Teams meeting with the team. Maybe you don't need a relatively in-depth consultation, but you nonetheless have got some questions how it all works. Well, there's different ways you can interact with ABC Wise. We do have live chat on our website. We do have the traditional telephone. So if you want to pick up the phone and talk to a human, you can do so between office hours Monday to Friday. We've also on the ABC Wise website got our Knowledge Hub, a great piece of kit on the Knowledge Hub. We've got the ABC Wise calculator, so you can actually type in your salary and then it will tell you what the gross and net cost is after the tax and NI savings. And then also gives you an idea, well, if you pay X in for Y period, potentially what could my pot grow to? So do have a look at that. We've also got some short explainer videos on our Knowledge Hub as well. Do familiarize yourself with the FAQ section as well. It's bespoke for each employer. A to Z of every question we've ever been asked on Shared Cost AVCs there. If you're after main scheme information, lgpsmember.org, encyclopedic knowledge there, how your main local government pension scheme works. And of course, those of you who like social media, by all means, you can always follow ABC Wise on both Twitter and Facebook, and you'll be kept up to speed with what we're doing all the time to spread the word of Shared Cost AVCs. Right, that's enough from me. I'm going to bring in Greg now to see whether we've had any questions. Greg.
Hi, Jonathan. And yes, we have, and thank you for a very clear and useful presentation. We've had a couple of questions have come through, mainly from Annie. And Annie was asking, can we put a lump sum into the Shared Cost AVC now? Well, Annie, as you've probably seen during the presentation itself, then you can only invest into the Shared Cost AVC through your salary. Now, I know you're going to request a one-to-one with the other comments you've made, but what I would recommend that you do is get your one-to-one, and then we'll explain how you can actually enhance or top up that AVC before the end of the tax year. And apart from that, the only other question I've got again is from Annie. That states, how does she get an up-to-date valuation of her AVC pot? So what you would need to do, Annie, is go back to your existing providers, so that's the Proof, Standard Life, wherever it may be, and they will provide that valuation for you. So at the moment, Jonathan, that's the bulk of the questions.
Right. Okay.
Yeah.
So, well, that's thank you, Annie. I hope for the rest of you, I made some sense around how income tax works and the importance of us planning for our respective futures. I think, you know, what we face in the UK at the moment is we do have a bit of a perfect storm on the economic front. We've got inflation, which is proving to be sticky. That's why the Bank of England put up interest rates just a fraction there. They may well have to go up a bit further to counter the effects of inflation. What it means for you, as I said earlier, if you've got some additional savings, not working hard, you've got to just be mindful of inflation eroding their real value. And then if you don't need some or all of that money, indirectly, you can put it into things like Shared Cost AVCs. Why? Because you're getting a double tax break. Grow that pot. And if you take it at the same time, potentially you can even get it back tax-free. You know, and if you can do that before the end of the tax year and lower your liability, because remember the other headwinds coming, well, they've frozen your personal allowance, only pay award, you're going to pay more tax on it. You've also got the other issue of national insurance looking to be going up by 1.25% as well. So it's all a bit of a perfect storm. So how do you shelter your personal wealth from that storm? Well, as I said earlier, the message is very clear. You look to pay money into efficient pension vehicles, and that's why you should be looking at Shared Cost AVCs. Your future self will thank you for doing these things. Thank you very much for your time this morning, and good morning.
So just before we close off, Jonathan, Steve Cox has just gone through with a late question.
All right.
In the early stage of which I can access my pension will soon increase to 57. So is this the age in which I can access my AVC pot? Well, Jonathan, Steve, it will be. There are potential rules where the pension ages will change, and it's linked to the state pension age. So if your state pension does go up to 67, then it's likely that the early stage you can access your local government pension scheme and the AVC pot will be 57 as well. And Helen has asked the last question that's just this minute come through. It says, can I take 100% AVC and then 25% of a local government pension scheme, or is it combined?
Yeah, the answer is it's combined. Now, very good question. So when you will have, so in isolation, your main local government pension scheme, and you'll see this on your annual benefit statement, they will say, well, look, this is your projected pension and whether you've got an automatic lump sum or not. They'll also give you a number to take maximum tax-free cash from LGPS, which is 25%. But what they don't do on your annual benefit statement is include whether you've got a shared cost AVC or not. So what you can't do, let's be very clear about this, and this is a very good point. What you can't do is say, well, just within my local government pension scheme itself, I take maximum tax-free cash, so commute my LGPS pension to realise as big as a lump sum, so take the full 25% there, and then additionally I've got my shared cost AVC and I want to take that all as tax-free cash. You wouldn't be able to do that. My point is that by having a shared cost AVC, whatever that pot is, it will then come under the umbrella at the point of retirement as part of the overall 25% tax-free cash. So in other words, you won't have to give up as much. If your strategy is to have as much tax-free cash as possible, you won't have to cancel as much of your local government pension to get to that 25% limit, because the shared cost AVC in its own right can form part of that 25% cash. So think of it potentially then, if you've got automatic lump sum, you've got your main local government pension scheme, pot 1. Pot 2 is any automatic lump sum, and you only have an automatic lump sum for service before April 2008. And if you've joined after that, there's no automatic lump sum, by the way. So again, even more reason to do shared cost AVCs, because you've got no automatic tax-free cash. But assuming that some of you do have automatic lump sum, and then pot 3 is what's in your shared cost AVC pot. They combine all three, and it's 25% of potentially all three. So I hope that makes sense.
And then the final question's just come through from Pauline, and she says, can you explain why you cannot put your full monthly salary into an AVC, leaving you, say, with £10?
Yeah. It would be great, wouldn't it, if you could just literally put everything in. Now, if you think about it, well, because you're doing it through salary sacrifice, there are certain rules. And those rules say you've got to leave enough in the tank each month to satisfy the national minimum wage. So that's why, for some members, the wings are clipped, around about, not in all cases, so it's case by case, but some people can do 60%, sometimes a bit more than that. Also, of course, you've got to pay your core contribution to LGPS out of your salary as well. So that's why you can't just get rid of every single penny, I'm afraid.
And Jonathan, that seems to be the last of the questions. So ladies and gents, thank you very much for attending today. Hopefully you found today's session of use. And hopefully speak to you again in the future. Take care. Goodbye.